This is the National Stock Exchange of India. Over the last few years, the number of retail investors moving through these digital pipes has grown to a level that few anticipated. GROWW sits at the center of that growth. With 21.6 million transacting users, they went public in late 2025 at 100 rupees a share and have watched their valuation climb steadily since. Traditional wealth management relies on a slow network of physical bank branches and human agents. GROWW replaced that entire infrastructure with a mobile interface. But scale is expensive. In fiscal year 2024, despite their massive user base, the company recorded an 8 billion rupee loss. Then, in just 12 months, the deficit vanished. By fiscal year 2025, they reported a profit of 3.3 billion rupees. Generally, giving away basic brokerage services for free is a recipe for burning through venture capital. At GROWW, that same free service appears to be the mechanism generating billions in earnings. Capturing a new investor is usually one of the most expensive hurdles in finance, requiring massive ad spends to win over customers from established banks. GROWW avoids those costs almost entirely. Roughly 80% of their user acquisition comes through organic channels and referral loops. They manage this by using AI-powered onboarding. It takes complex regulatory requirements and turns them into a series of automated, instantaneous background checks. Because they pay almost nothing to land a user, that customer is structurally profitable from the moment they open the app. There is no marketing debt to pay off. Once millions of people are inside the app, the challenge is maintaining the infrastructure. To scale without breaking, GROWW built its own proprietary technology stack. This diagram shows their internal technology ecosystem. It is built to handle 50 million simultaneous users and process up to 50 million orders every single day. The architecture allows for massive concurrent connections, maintaining trade speeds that match the national average for UPI payments. By owning the tech, they create operating leverage. The cost of the underlying servers and code is largely fixed, meaning the cost of adding one more user is effectively zero. You can see the results in the company's operating margins. In fiscal year 2023, their cost to operate consumed over 26% of their revenue. By 2025, that percentage dropped to 13.77%. GROWW functions as a hyper-efficient data engine, where massive scale mathematically forces the cost of doing business to decline as the user base grows. This efficiency creates the opening to monetize. Once a user is active on the low-cost infrastructure, the platform begins to cross-sell. A customer may join to buy a single mutual fund, but over time they are funneled toward higher-margin products like personal loans or margin trading facilities. Their 2025 fiscal report confirms the success of this pipeline. Fees and commission income reached 33.3 billion rupees. Low-cost acquisition, combined with a fixed-cost tech stack, means that when users finally purchase premium financial products, a significant portion of that revenue flows directly into profit. The retail investors who joined the platform years ago are now accumulating real-world wealth. As their portfolios grow, their needs change. To retain these customers as they mature, GROWW launched Prime, a tier tailored specifically for mass affluent users who require more sophisticated tools. For the high-net-worth segment, they introduced GROWW by GROWW. This moves away from the digital-only model by assigning dedicated human relationship managers to each customer. They have also expanded through acquisition, absorbing operations like Fisdom to quickly scale their advisory services and bank partnerships. GROWW has built a system that captures users at the start of their investing lives and monetizes their entire lifetime wealth journey.